Hey everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in today. We're continuing our video series on the history of the Federal Reserve, and in the last video we discussed the involvement of the Fed in the First World War, and in this video we are going to discuss the few years after the end of the war, including the very deep recession which occurred in 1920-1921. Now, the First World War ended in November of 1918. And as we discussed in our last video, the Federal Reserve kept interest rates very low to help finance the war. There was a massive influx of gold as the United States was exporting goods and material to the belligerent countries. And this massive influx of gold led to a big surge in the money supply. So you had a booming economy throughout the war, but you also had a lot of inflation. And when the First World War ended, that should have been a signal to begin to raise rates and kind of normalize policy. Now, at the time, the Federal Reserve had a different kind of policy than they do now. First of all, they relied on the discount rate, which was a rate in which they would lend against acceptable collateral, what they would often call commercial bills, but they would lend against Treasury securities as well. And each bank, each of the 12 banks, would set its own policy. So there could be a great divergence of policy, of this policy rate throughout the country. And we'll see that in a few minutes as we talk about the impact on the farm economy. But in the summer of 1919, there was a gold embargo that persisted throughout the war. And in the summer of 1919, this gold embargo was lifted. And between the lifting of the gold embargo and the somewhat of normalization of the economies in Europe, there was a massive outflow of gold from U.S. banks. And the Federal Reserve System, by October of 1920, the Federal Reserve System saw gold reserves dip to almost the 40% statutory limit. So the Federal Reserve had to increase interest rates in order to try to rebuild their gold stocks. They were also trying to discourage credit for being used for speculative purposes. We're going to see this a lot when we talk about the Fed in the 1920s. So they increased rates very sharply. New York, Boston, and Chicago in the fall of 1920 increased their discount rate up to 7%. That was a very sharp increase in a very short period of time. It puts the country into a very deep recession. And unemployment, by some estimates, unemployment hit 12%. Industrial production was down in the double digits. Wholesale prices were down in the double digits. So you had this massive deflation. Now, I want to talk a bit about the farm economy during this period. Now, farmers had a boom throughout the war. You had a commodities boom, and farmers borrowed very heavily against inflated land prices and inflated commodity prices. So they were heavily in debt by the time the war was over. In 1920, April 1920, Congress passes something called the Fallon Act. This act gave the Federal Reserve the authority to charge progressive interest rates on banks that borrowed over above a certain threshold. And this actually has a disproportionate impact in parts of the country that relied very heavily on agriculture. So in addition to farmers being kind of mortgaged to the hilt, they end up paying much higher interest rates than other industries. And of course, this creates a lot of problems. Despite the boom that happens later in the 1920s, the farm economy is really in a depression from 1920 well into the 1930s. And it's important to keep that in mind as we go through later videos and we talk about the Depression, just how overly indebted farmers were during this period. But the higher interest rates, despite the very deep deflation, the higher interest rates do finally start to lead to large gold inflows. And by 1921, the New York Federal Reserve was sitting on over double the required minimum limit. So their gold reserves were over 80%. I think it was 82% at that time. Now, when Andrew Mellon became Treasury Secretary, he was very much in favor of lower interest rates. So it was a combination of finally getting some political pressure and also the excess gold reserves that finally get the Federal Reserve to bring down interest rates. It leads to one of the sharpest recoveries in U.S. history. So despite the severity of the recession, it's short-lived and the recovery is very strong. And as we'll see in our next few videos, this really sets the scene for the boom of the 1920s. We'll see everyone next time.